What if I told you that being good with money has little to do with how smart you are and everything to do with how you behave? That your financial success isn't determined by what you know about the stock market, but by your relationship with greed, fear, and the stories you tell yourself about money. In a world obsessed with complex investment strategies and get-rich-quick schemes, Morgan Housel's The Psychology of Money delivers a refreshing truth. The most important factor in building wealth isn't your financial IQ, it's your financial behavior. Today, we're diving into this game-changing book that explains why a kindergarten teacher can amass millions while Wall Street executives go bankrupt. Why the world's best investors succeed not through brilliant analysis, but through controlling their emotions. And why your personal history with money might be sabotaging your financial future without you even realizing it. Stay with me, because what you're about to learn could completely transform your relationship with money and set you on a path to genuine financial freedom that has nothing to do with your income level or investment knowledge. Hey everyone, welcome back to the channel. Today I'm incredibly excited to share insights from a book that has genuinely changed how I think about money and investing. The Psychology of Money by Morgan Housel. Before we dive in, I want to share something personal. For years, I thought financial success was all about finding the perfect investment strategy or predicting market movements. I spent countless hours studying complex financial theories, technical analysis, and economic forecasts. Despite all this knowledge, my own financial decisions were often emotional, inconsistent, and sometimes even irrational. That's why Housel's message resonated so deeply with me. He argues that finance isn't primarily a math-based field, it's a psychology-based field. Doing well with money isn't necessarily about what you know, it's about how you behave. The Psychology of Money explores how our unique personal experiences, cognitive biases, emotions, and the stories we tell ourselves shape our financial decisions, often in ways we don't even realize. Through 19 short chapters, Housel delivers profound insights using simple language and compelling stories that stick with you long after you've finished reading. What makes this book different from other financial advice is that Housel doesn't offer a specific investment strategy or a step-by-step plan to get rich. Instead, he provides something far more valuable. Throughout this video, we'll explore the key insights from Housel's work and how you can apply them to transform your own financial life. Whether you're just starting your financial journey or you've been investing for decades, this book offers wisdom that can benefit everyone. Let's start by understanding Housel's core premise. Financial decisions are not made in a spreadsheet. They're made at the dinner table. They're wrapped up in our hopes, dreams, fears, prejudices, and the unique experiences that have shaped our view of money. No One's Crazy Housel begins with a powerful insight. When it comes to money, none of us is objectively crazy because we're all making decisions based on our own unique experiences. He explains that our relationship with money is highly personal, formed by the specific economic conditions, cultural norms, and family dynamics we've experienced in our lifetime. Someone who grew up during the Great Depression will have an entirely different approach to money than someone who came of age during the tech boom of the 1990s. Housel writes, "Your personal experiences with money make up maybe 0.000000001% of what's happened in the world, but maybe 80% of how you think the world works." To illustrate this point, he shares the story of Ronald Reed, a janitor who amassed an $8 million fortune by saving consistently and investing in blue-chip stocks over decades. In contrast, Richard Foscone, a Harvard-educated Merrill Lynch executive with all the right knowledge, went bankrupt. Their outcomes weren't determined by knowledge, they were determined by behavior. This explains why financial advice often falls flat. What works for one person might be terrible advice for another, because we're all operating from different perspectives shaped by our unique histories. I've seen this in my own life. My grandparents, who lived through economic hardship, have a completely different relationship with money than my younger siblings who grew up in a time of easy credit and digital transactions. Neither approach is crazy. They're both products of different experiences. Housel introduces a crucial concept here: the difference between being rational and being reasonable. A financial decision might not be rational according to economic theory, but can still be reasonable given your personal circumstances and psychology. For example, keeping more cash than necessary might not be mathematically optimal, but if it helps you sleep at night and prevents you from panic selling during market downturns, it's a reasonable decision for you. The key takeaway from this section is to develop self-awareness about your own money psychology. Instead of judging financial decisions as objectively right or wrong, ask, given my unique experiences and personality, what approach to money will work best for me? Luck and risk. In this enlightening section, Housel tackles a truth many of us don't want to acknowledge: the role of luck and risk in financial outcomes. He makes a profound observation: focus less on specific individuals and case studies and more on broad patterns. The problem with financial success stories is that they often emphasize skill and strategy while downplaying the role of luck. Similarly, financial failures are attributed to poor decisions while ignoring the role of bad luck. Housel explains that when we study successful investors or entrepreneurs, we can't always separate their skill from their luck. Bill Gates was undoubtedly talented, but he also happened to attend one of the few high schools in America with access to a computer terminal in 1968. How many equally talented kids never had that opportunity? This perspective is surprisingly liberating. Recognizing the role of luck doesn't mean giving up on effort or skill development. Instead, it means 1. Being more humble about your successes, 2. Being more compassionate about others' failures, 3. Focusing on things you can control rather than trying to replicate someone else's exact path. Housel introduces the concept of risk as the flip side of luck. Even the best financial decision can lead to bad outcomes in certain conditions, and even poor decisions can occasionally yield positive results. He shares the story of Cornelius Vanderbilt, who built a shipping and railroad empire that made him one of the wealthiest Americans in history. While his success reflected genuine skill, it also depended on being born at precisely the right moment when the Industrial Revolution was creating unprecedented opportunities in transportation. I found this section particularly eye-opening because it challenges the prevalent narrative that financial outcomes are purely meritocratic. How often have we judged ourselves harshly for financial setbacks that partly resulted from factors beyond our control? Housel suggests a more nuanced approach. Acknowledge luck and risk, but focus on broad patterns that tend to work over time rather than trying to replicate any individual's exact path to wealth. The key takeaway is to build financial strategies that acknowledge luck and risk. This means diversifying to protect against bad luck, giving yourself margin for error, and recognizing that no financial strategy works 100% of the time. Never enough. In this powerful section, Housel explores one of the most dangerous financial traps: the inability to know when you have enough. He tells the story of Rajat Gupta, a man who rose from orphan to head of McKinsey and board member at Goldman Sachs, with a net worth of $100 million. Despite this extraordinary success, Gupta engaged in insider trading to make even more money, ultimately losing his reputation, career, and freedom. This leads to Housel's profound insight: the hardest financial skill is getting the goalpost to stop moving. When we reach a financial target, instead of feeling satisfied, we often move the goalpost and set a new, higher target. This creates a never-ending cycle of striving without satisfaction. He identifies 3 levels of wealth. 1. Survival money, having enough to meet basic needs. 2. Comfort money, having enough for financial freedom and security. 3. Status money, using wealth to climb social hierarchies. The pursuit of status money is particularly dangerous because there's no logical stopping point. No matter how wealthy you become, there's always someone richer to compare yourself to. Housel writes, social comparison is the problem here. The point is that the ceiling of social comparison is so high that virtually no one will ever hit it, which means it's a battle that can never be won. I've witnessed this in my own life. Friends who once said they'd be happy with a certain salary or net worth achieve those goals only to immediately set new, higher targets, never actually experiencing the contentment they thought the money would bring. Housel offers a powerful antidote. Enough is not a specific dollar amount. It's the point where money brings freedom rather than additional burden. True wealth, he suggests, is having the freedom to control your time without having to worry about money. He shares the example of a friend who left a high-paying but demanding job to start a small business that earned less but gave him control over his schedule. His income decreased, but his happiness and sense of wealth increased dramatically. The key takeaway is to define enough for yourself before embarking on a financial journey. Ask yourself what you truly value: time, experiences, security, creative freedom, and build financial goals around those values rather than endlessly chasing higher numbers. Compounding. In this section, Housel reveals what he considers the most important topic in investing: the astonishing power of compounding. He begins with a striking example. Warren Buffett began investing when he was 10 years old and built a net worth of $84.5 billion by his late 80s. Of that massive fortune, $84.2 billion came after his 50th birthday, and $81.5 billion came after he qualified for Social Security. Despite being the world's most famous investor, the vast majority of his financial success came from simply remaining invested for an extremely long time. Housel explains that humans are not wired to intuitively grasp exponential growth. We think linearly, but compounding works exponentially. This cognitive limitation leads many investors to focus on short-term returns while undervaluing the incredible power of long-term compounding. He offers a mind-blowing calculation. If you earn a 1% return every month, which doesn't sound impressive, that compounds to nearly 13% annually. After 30 years, an initial $1 becomes $19.79. After 40 years, it becomes $52.80. The additional 10 years more then doubles your money. This mathematical reality leads to what Housel calls the counterintuitive nature of compounding. The most powerful outcomes happen at the very end, which means the benefits of compounding are rarely appreciated until it's too late to take advantage of them. I found this perspective transformative in my own financial thinking. Before understanding compounding, I was constantly looking for investments that could deliver quick, impressive returns. Now I focus on consistency and time horizon, knowing that even modest returns, if given enough time to compound, can lead to extraordinary outcomes. Housel provides a simple but profound formula for financial success. Good investing isn't necessarily about earning the highest returns. It's about earning pretty good returns that you can stick with and which can be repeated for the longest period of time. The practical implications are clear. 1. Start investing as early as possible. 2. Focus on sustainable investment strategies you can stick with long-term. 3. Avoid catastrophic mistakes that take you out of the game. 4. Measure your investing horizon in decades, not years. The key takeaway is that patience is the supreme virtue in investing. The most important question is not, how can I earn the highest returns? But rather, what strategy will I actually stick with for decades? Getting wealthy versus staying wealthy. In this illuminating section, Housel makes a crucial distinction that many financial books overlook. The strategies required to build wealth are often different from those needed to maintain wealth. He begins with a powerful observation. Getting money requires taking risks, being optimistic, and putting yourself out there. But keeping money requires the opposite of taking risks. It requires humility and fear that what you've made can be taken away from you just as fast. Using evolutionary psychology, Housel explains that humans have evolved in an environment where aggressive risk-taking was often necessary for survival. But in investing, survival is everything. No matter how skilled you are, if you take risks that lead to ruin, you're out of the game. He shares the example of Jesse Livermore, a legendary investor who made and lost several fortunes. In 1929, Livermore correctly anticipated the Great Depression and made $100 million, equivalent to over $1.5 billion today. Yet by 1934, he had lost it all through excessive risk-taking and eventually took his own life. Housel introduces the concept of financial room for error, which he defines as the gap between what you think will happen and what can happen while still meeting your financial goals. The wider this gap, the more resilient your financial plan. I've applied this principle in my own finances by maintaining an emergency fund that's larger than most financial advisors recommend. While this might not be mathematically optimal, it provides psychological security that helps me stick with my investment plan during market downturns. Housel offers several practical strategies for building this financial room for error. 1. Save more than you think you need. A high savings rate provides flexibility and security regardless of investment returns. 2. Expect lower returns than historical averages. Plan as if returns will be modest, then be pleasantly surprised if they exceed expectations. Third, hold cash reserves. Despite low returns on cash, having liquid reserves provides optionality and prevents forced selling during market downturns. 4. Diversify, not just across asset classes, but across time horizons and strategies. He shares Warren Buffett's approach. We will have no debt, and we will hold no financial assets that can go bad in short periods of time. Despite his renowned investing skills, Buffett prioritizes safety above maximum returns. The key takeaway is to shift your mindset from maximizing returns to increasing the odds of long-term success. As Housel puts it, planning for room for error, a margin of safety, is underappreciated and misunderstood. Rather than viewing it as being cautious, consider it as giving yourself endurance to stick around long enough for compounding to work its magic. Tails, you win. In this fascinating section, Housel introduces the concept of tail events, rare extreme outcomes that have disproportionate impacts on results. He begins with a surprising insight about venture capital. Despite its reputation for astronomical returns, most venture investments lose money. In fact, a study of 22,000 venture investments showed that 65% lost money and only 4% returned more than 10 times the initial investment. Yet those rare 4% of investments accounted for the majority of the venture capital industry's returns. This pattern extends far beyond venture capital. In many areas of investing in business, most stocks in the S&P 500 underperform the index. Most books lose money for publishers. Most scientific research leads to dead ends. Most entrepreneurial ventures fail. Success comes from the small percentage of big winners that make up for all the failures. Housel calls this the Pareto principle on steroids and explains that it leads to a counterintuitive investment strategy. You can be wrong half the time and still make a fortune. This has profound implications for how we should approach investing. Instead of trying to avoid all mistakes, which is impossible, successful investors: 1. Accept that mistakes and losses are an inevitable part of the process. 2. Ensure that no single mistake can wipe them out completely. 3. Position themselves to benefit from occasional massive winners. Housel shares the story of Amazon, which has launched many failed products. Remember the Fire Phone? Yet the success of AWS Prime and its e-commerce platform has more than compensated for these failures. Jeff Bezos embraced this asymmetric approach, saying, "Given a 10% chance of 100 times payoff, you should take that bet every time." I found this perspective incredibly liberating. Instead of beating myself up over investment mistakes, I now see them as an inevitable part of a process that can still lead to overall success, as long as I stay in the game long enough to benefit from the occasional big winners. Housel provides several practical applications. 1. Diversification isn't just about minimizing risk. It's about increasing your odds of catching a tail winner. 2. Focus on survival first. You can't benefit from compounding if you're taken out of the game by a catastrophic loss. 3. Accept that you'll be wrong often, but structure your investment approach so that the magnitude of your wins can far exceed the magnitude of your losses. The key takeaway is to embrace the asymmetric nature of investment returns. Success doesn't come from being right all the time. It comes from being positioned to benefit when things occasionally go extraordinarily right, while ensuring you can survive when things go wrong. Freedom. In this profound section, Housel explores what might be the most overlooked benefit of money: the freedom it provides. He begins with a powerful observation. The highest form of wealth is the ability to wake up every morning and say, "I can do whatever I want today." True wealth isn't about fancy cars or luxurious homes. It's about having control over your time and the freedom to make choices without financial constraints. Housel challenges the conventional view that equates wealth with income or material possessions. Instead, he suggests that controlling your time is the highest dividend money pays. A person with modest financial means but complete control over their time may actually be wealthier in a meaningful sense than someone with millions who is chained to work they dislike. He shares the story of a friend who quit a high-paying job to start a woodworking business that earned far less but gave him control over his schedule and the type of work he did. While his income decreased by 75%, his sense of wealth and happiness increased dramatically. This perspective shifted my own financial goals. I realized I had been pursuing higher income without clearly defining what that money was actually for. When I redefined wealth as having options and flexibility, it changed both my career decisions and my spending habits. Housel introduces several practical insights about the relationship between money and freedom. 1. Money's greatest value is optionality. The ability to pivot, change course, or wait when others need to act immediately is an underappreciated form of wealth. 2. Reasonable, not necessarily optimal. Choices that seem financially suboptimal, like maintaining high cash reserves, may actually be reasonable if they provide psychological security that helps you sleep at night. 3. The cost of independence. True financial freedom often requires accepting lower returns or lower income in exchange for greater control. He challenges readers to consider what their own enough looks like. For some, it might be saving enough to retire early. For others, it might be having sufficient resources to work part-time or switch to a lower-paying but more fulfilling career. I love Housel's analogy. The ability to do what you want, when you want, with who you want, for as long as you want, is priceless. It is the highest dividend money pays. The key takeaway is to reframe your financial goals around freedom rather than arbitrary numbers. Ask yourself what kind of freedom you're seeking. Freedom from financial stress? Freedom to change careers? Freedom to spend time with family? And build your financial strategy to support that specific vision of freedom. The psychology of money. In this essential section, Housel explores how our psychological biases affect financial decisions and offers practical strategies for key takeaways. Let's summarize the most powerful insights from the psychology of money. 1. Your financial decisions are personal. There's no single right approach to money. What works depends on your goals, psychology, and circumstances. 2. Luck and risk play huge roles. Acknowledge the role of factors beyond your control and build strategies that can succeed despite uncertainty. 3. Know when you have enough. Define your personal enough to avoid the endless treadmill of wealth pursuit without satisfaction. 4. Compounding is the ultimate force. Small returns sustained over long periods create extraordinary wealth. Patience is the supreme financial virtue. 5. Getting wealth and keeping wealth require different strategies. Building wealth often requires optimism and risk-taking. Preserving wealth requires humility and caution. 6. Tails drive everything. A small number of extraordinary outcomes often determine financial success. Position yourself to benefit from occasional big wins. 7. Freedom is the highest form of wealth. The ability to control your time and make choices without financial constraint is the ultimate dividend money pays. 8. Manage your psychology. Your behavior and emotional control matter more than specific investment tactics or knowledge. 9. Save like a pessimist, invest like an optimist. Maintain conservative reserves for life's surprises while investing with the belief that human innovation will create long-term progress. 10. Room for error is essential. Build financial plans with enough flexibility to survive the inevitable surprises and setbacks you'll face. The psychology of money offers a refreshing perspective in a world obsessed with complex financial strategies and market predictions. What makes Housel's approach so valuable is its focus on the human side of money, the behaviors, emotions, and psychological factors that ultimately determine financial outcomes. The beauty of this approach is that it works regardless of your income level, market conditions, or economic environment. While investment strategies come and go, the principles of good financial behavior remain constant: patience, humility, consistency, and self-awareness. I encourage you to reflect on which insights from this book resonated most strongly with you. Perhaps it was the power of compounding, the importance of defining enough, or the idea that true wealth is measured in freedom rather than dollars. Whatever speaks to you, consider how you might translate that insight into a specific change in your financial approach. Maybe it's increasing your savings rate, extending your investment time horizon, or simply reframing your definition of financial success. Remember that financial success isn't about following someone else's formula perfectly. It's about developing an approach that works with your unique psychology and goals. As Housel writes, the premise of this book is that doing well with money has little to do with how smart you are and a lot to do with how you behave. I highly recommend reading the full book, as there are many more valuable insights and stories than I could cover in this video. Housel's clear writing style and use of compelling examples make complex financial concepts accessible and memorable. If you've read The Psychology of Money or plan to pick it up after watching this video, I'd love to hear your thoughts in the comments below. Which concept resonated most with you? What aspect of your financial approach are you rethinking? This book has genuinely changed how I think about money and investing. I hope it does the same for you. Don't forget to like this video if you found it valuable, and subscribe for more in-depth book summaries that can help transform your financial life. Thanks for watching, and remember, behavior is the most important factor in your financial success.